Hi, Ron Benning here with your Sacramento Duplex market update for February of 2026. In this video, we're going to look at what actually happened in the January duplex market, what the current break-even GRM is for a Sacramento duplex, and what it means for pricing, interest rates, and investor opportunities over the next few months. So make sure you watch to the end so you know exactly where this market is headed. And as always, if you haven't already subscribed to my channel, please subscribe now so you don't miss any of my future market updates and cash flow alerts. We're starting 2026 in a seller's market for duplexes in Sacramento with 2.2 months of supply based on closed sales. Anytime inventory is below 3 months, sellers have more leverage. That 2.2 month supply is down 21.8% from December, which tells us inventory is tightening fast. But the seller's market may be a short term illusion because that tightening is coming from active inventory collapsing. Duplex listings are down nearly 24% from last month. There simply isn't much new supply hitting the market. When we look at months of inventory based on pending sales, however, we see 3.5 months of supply, which puts the market in a neutral zone. That number's up 51.8% from last month, which tells us something important. Buyer activity slowed even faster than the inventory has fallen. There are 19 duplexes currently under contract, which is a 50% drop from December and down 9.5% from last year. That's a major cooling signal from buyers, and it matters. Next, I want to talk about this large expectation gap between buyers and sellers. Let's look at that gap between what sellers want and what buyers are actually paying. The average for sale price in January for a duplex was 696,000, which is up 5.8% over the last 12 months. But the average sold price was only 600,000, which is down 1.2% from last year. This growing expectation gap between the list price that sellers want and the sale price should concern every investor, particularly sellers. Sellers are still pricing like it's 2021, but buyers are paying like it's 2026. And that disconnect leads to longer days on the market, more unsold inventory, and eventually will probably put some significant price pressure on sellers. Next, let's take a look at some sales activity. January had 31 closed duplex sales, which is up 29.2% from last year, but it's down about 3.1% from December. That tells us demand is still stronger than 2025, but it's clearly cooling month to month. We now have fewer listings, far fewer pendings, and slightly fewer closing. That means the market is tightening due to a shrinking supply, not rising demand. And that's a fragile kind of a seller's market. The days on the market, the average days on the market was 48 days in January. That's down 2% from last month, but it's up 84.6% from last year. So well priced duplexes still sell, but overpriced listings sit. This is what a late cycle seller's market looks like. Next, let's take a look at the buyer bargaining power. The sold to list price ratio came in at 97% this month, which means buyers are getting about 3% off asking price. Even in a seller's market, buyers still have some negotiating power, especially on properties that have been on the market longer than 30 days. Cash flow reality. With investor interest rates about 6.25 and 25% down, the current break-even GRM is about 12.69. That means duplexes must be priced extremely efficiently to cash flow. Yes, some deals are still hitting that number, but they're the exception, not the rule. GRM discipline is now more important than at any point in the past several years if you're trying to break even or make a profit. Next, let's talk about the interest rates and the outlook for 2026. Rates remain one of the most important drivers of the market. Investor loan rates for duplexes are still running between 6.25 and 6.5, much higher than during the easy money years. And most forecasts for 2026 show rates drifting slowly lower, but not improving substantially. That means demand may stabilize, but affordability will continue to cap prices. What this means for investors, we now have tighter inventory, a cooling buyer demand, rising list prices with flat to declining sale prices. This is a dangerous combination. Over the next 45 days, I expect a seasonal increase in listings and continued selective buying. And more than likely, as inventory starts to go up, as is normal this time of the year, there's probably going to be more price pressuring on overpriced properties. So, depending on rates, if rates rise, this seller's market could weaken really quickly. If rates fall, inventory could tighten further, but only quality deals are selling for the most part. Final advice for buyers: as always, opportunities still exist, but only if you stay disciplined, and you really need to focus on the properties with a good GRM or a good value add duplex with upside. For sellers, pricing matters as always. And this widening expectation gap between the list price and the sale price makes sellers a little bit more vulnerable over the next few months if this doesn't close a bit. If you're not already receiving my weekly GRM report or would like a rent analysis or a property valuation on your property, scan the QR code on the screen or check in the links below. Let me know what videos you'd like me to make over the next few months, and whether you're planning to buy or sell in the next 7 days or 7 months, give me a call or a text. I'd be happy to help you plan a smooth and profitable real estate transaction.